Welcome to Breaking News to Trading Moves. We're looking at a recent equity move in the utility sector today, one that helps us understand who profits from these big capital raises and, well, who bears the cost.
We are, yeah. We're focusing on MDU Resources Group, ticker MDU, and a public share offering they just did. And this action, it's a great stencil for understanding the market dynamics for everyone involved, from the big banks to the renewable energy contractors, right down to income investors.
Okay, let's get right into the specifics of what MDU did. What are the core details of this offering?
So MDU Resources Group, again, that's ticker MDU, priced a public offering of about 10.1 million shares at $19.70 per share.
1970, okay.
But the crucial part really is how they did it. They used a forward sales structure.
A forward sales structure. Now, for listeners who might know about regular equity raises, but maybe not this specific mechanism, what does that actually mean?
It's a way for a company to get the money committed now, but without flooding the market with all the new shares at once. Essentially, they sell the shares to the banks today, locking in the price, but the banks only have to buy or borrow those shares later on.
So MBU gets the funding locked in, but the actual shares, the ones that cause the dilution we're going to talk about, they haven't really hit the market yet.
Exactly. It's like pre-ordering a stock delivery that will happen down the road. It helps manage the immediate price pressure.
And the purpose for raising all this capital?
The funds are set aside for a few key things: paying down some debt, general capital spending, and specifically a big investment in a new wind farm.
So on one hand, that's good. It funds growth, it funds renewables, pays down debt. But what about the people already holding the stock? What's the immediate effect of knowing 10 million new shares are on the way?
Well, the immediate effect is the promise of dilution. It's just simple math, really. When new shares enter the market, the company's earnings have to be split among more pieces.
So it puts pressure on earnings per share, or EPS.
Right, and on future dividend growth per share, too, especially until that forward sale is totally done and all the shares are out there.
That sets the stage perfectly. So let's turn to the winners, the groups that benefit when MDU decides to raise capital this way. We see three pretty distinct categories here.
That's right. The first and maybe the most obvious winners are the deal banks and the capital markets players.
They make money immediately, right, before a single shovel hits the ground for that wind farm.
Absolutely. They get paid in a couple of ways. First, there are the underwriting fees for just putting the deal together. And second, because it's a forward sale, the banks have to hedge their position until the shares are delivered.
And that hedging creates more trading activity.
A lot more. It means more revenue for their trading desks. For them, it's a pretty lucrative, low-risk situation.
And who are the specific names we're talking about here? Who gains?
You're looking at the key players in this space. Think Wells Fargo, ticker WTEFC, Bank of America, ticker BAC, and of course, JPMorgan Chase, ticker JPM.
Okay, so after the banks get their fees, the money moves to MDU. And that brings us to the second group of winners, the utility infrastructure and renewables contractors.
Yes, this is where that capital spending plan becomes real. MDU's commitment to a bigger capex plan means more money flowing into new projects, grid work, pipelines, and especially renewables.
So that directly supports the backlogs of these infrastructure companies.
It does. It gives them visibility. It turns a potential project on a spreadsheet into a funded contract in their order book.
So which companies are best positioned to get a piece of that spending?
You'd look at companies like Quanta Services, ticker PWR, and MasTech, which is MTZ. For them, a utility raising capital for new projects is very good news.
Now, the third winner category is a bit different. It's not about a direct payment, but more about market sentiment. You call it the rotation play into higher quality or steady utilities. How does that work?
Right. This is more of a defensive win. When MDU announces a dilutive stock offering, some investors get a bit nervous. They might sell their MDU shares.
But they don't leave the utility sector entirely.
Often, no. They just move their money.
Yeah.
They rotate that capital into other regulated utilities that are seen as better funded or less likely to surprise the market with an equity raise of their own.
So they're basically fleeing to perceived safety within the same sector.
That's a great way to put it. They're looking for companies with more predictable financing plans, management teams that can fund growth without constantly issuing new stock.
Can you give us a few examples of who might receive that rotated capital?
Sure. Companies like XL Energy, ticker XEL, and WEC Energy Group, ticker WEC, they tend to benefit when investors are looking for a safer harbor in the utility space. So we've talked about where the capital flows and who's collecting fees. Now we have to look at the other side of this. The consequences of this kind of capital raise are felt by a few groups, starting, funnily enough, with the company that issued the stock in the first place.
That seems a little counterintuitive. MDU is a loser here even after getting all that funding.
Yeah.
Why?
Well, for its stock, yes, in the near term. We already talked about the pressure on per-share metrics like EPS and dividends. But the forward sale also creates what the market calls an overhang.
An overhang.
Yeah, everybody knows those 10 million shares are coming eventually. That knowledge, that promise of future supply, tends to hold the stock price down. It's like a weight on the stock until the deal is fully resolved.
And does this just affect MDU? Or do investors start looking at other similar companies and get worried?
Oh, it definitely creates a read across. Investors will immediately look at other mid-cap regulated utilities and wonder if they're next.
So who else might feel some of that pressure?
A company like Portland General Electric, ticker POR, could. Investors start asking, does this company also have big capital needs that might require a dilutive stock sale soon? It raises the perceived risk for that whole group.
Okay, let's move to the second loser category, which you called growth or equity-dependent utilities.
Right. These are companies that have really ambitious growth plans that, rely on being able to raise money from the stock market again and again.
And if the market suddenly becomes less willing to absorb those new shares,
Then their whole valuation comes under pressure. The market starts to discount their future growth because the cost of funding it just went up, or at least the perceived risk did.
which companies fit that profile? The ones with big capital expenditure plans.
You'd think of some of the larger names with huge growth pipelines like Nextera Energy, ticker NEE, and Duke Energy, ticker DUK. Their valuations are very tied to the market's belief that they can fund their long-term plans smoothly.
And finally, a group that is absolutely central to the utility sector, the yield-focused investors, the people who own these stocks for the dividend.
This group is all about the per-share dividend. For them, consistency is everything. When a company issues a lot of new stock, it directly caps the potential for dividend growth.
Because the same pool of profit now has to be spread across more shares.
Exactly, so there's less left over per share to hand out to investors. It hurts the overall sentiment for that entire investor class who really just want boring, predictable capital management.
So which big dividend names might face some scrutiny if this becomes a trend?
Well, investors might look at longtime mainstays like Consolidated Edison, ticker ED, or Southern Company, ticker SO. Any feeling that the sector is getting more aggressive with equity issuance could cause some concern for the income-focused holders of those stocks. So what we've really explored today is how a single decision by one company funding growth with a stock offering has these very specific consequences across the energy and finance landscape. It affects everything from bank revenues to contractor backlogs.
It provides a pretty clear blueprint, really. It gives you, the listener, the tools to analyze the winners and the losers when a utility decides it needs to prioritize funding big new projects like a wind farm over maybe maximizing per-share metrics in the short term.
And before we wrap up, we have to give a required notice. This is not financial advice or any kind of buy or sell recommendation. This is purely the opinion of the author.
So something for you to consider. If utilities are turning more and more to the stock market to fund the energy transition, how will that trade-off between necessary infrastructure investment and investor demand for consistent per-share returns play out over the next few years? That's something to think about as you follow these markets.